have another massive show here, an enormous amount of information. A ton is going on here, under the radar, so to speak, hiding in plain sight in a Wall Street Journal article that we will begin with. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli, and as the tagline under the Northern Miner logo says on the Northern Miner website, global mining news, and indeed, it feels like the world news here. Resources and, frankly, war. As we're going to see, as this Wall Street Journal article begins with, and this is by Yusuf Khan, and this came out on March 15th, mining the ocean floor for minerals often seem like a fantasy, but U.S. national security concerns could be bringing it closer to reality. And they talk about something which we've already known, which is the large amount of nickel, manganese, and cobalt that can be found in these nodules, what look like round golf balls that can be picked up off the ocean floor. As we discussed with Gerard Barron of what is now TMC, but at the time was Deep Green, and before that was Nautilus Minerals. So we actually have explored this topic years ago, and now here we are, big write-up in the Wall Street Journal. And here's a quote from that article. This is Samir Kapadia, a Vogel Group lobbyist backed by the metals company, TMC. Quote, without question, the narrative around deep-sea mining has gone through an inflection point in that it has clearly found a home in the context of national security. And so again, we're going to see more of this discussion in the Eastern DRC later in this introduction. Conflict minerals. It really is quite something to see, you could argue, the most serious matters of governance, war, and how minerals are right at the heart of this whole discussion here, as we're seeing in the Wall Street Journal. Now, continuing on here, I just want to touch a couple of things here. We have a letter that was sent to U.S. Secretary of Defense Lloyd Austin from more than 30 Republican members of Congress. And in that letter, it said, quote, we cannot afford to allow China to capture and exploit seabed resources, which the CCP has characterized as, quote, a new frontier for international competition, end quote. We must explore every avenue to strengthen our rare earth and critical minerals supply chains. And to review, we have seen a story about 2 or 3 weeks ago where China was getting permits from the ISA, the International Seabed Authority, to explore underneath the Indian Ocean, right? Because we're dealing with the high seas, we're dealing with international waters. So with that, in a sense, you're not limited to whatever it is, 200 kilometers or 20 kilometers off your coastline. It's a completely different game. So now members of Congress are waking up to this whole reality. As it says here in the article, the country, referring to China, holds 5 contracts to explore the seabed for minerals in international waters more than anyone else. The next highest is Russia. China has also been sending ships out for research into the Pacific Ocean, alarming lawmakers in the U.S. And don't forget that story from maybe December, early January. Remember when the U.S. just announced unilaterally that it was expanding its sovereignty off its coasts, like massively? And you could see the map, and it was like incredible. Also into the Arctic with Alaska, but also off the West Coast, like a huge amount. And one wonders, is this about deep sea mining? Is this about critical minerals? So a very interesting story here. And as a matter of fact, Gerard Barron, again, who has been on this show maybe 3 years ago, is quoted in this article, again, from the metals company now. Here's the quote. In our presentation decks from over a decade ago, we talked about the security of supply. It's something we have always talked about. With defense, it is showing broadly what the U.S. has woken up to. That if you want mineral independence, it's a case of how you do that. So there is Gerard Barron in this very important article, one could argue, in the Wall Street Journal. And one more quote, and this is from Republican Robert Whitman. Quote, the critical minerals needed for the construction of our combat systems of ships and planes and other aspects of things critical to the military, all of a sudden it was very apparent that there were shortcomings in a lot of those areas. We could be at the mercy of China if we don't really lift our game and get into this area of deep sea mineral deposit claims. Now, interestingly, if you go back to that show with Gerard Barron, it does seem, according to Gerard Barron's point of view, a relatively benign way of mining. I mean, he was simply suggesting that you send out little mini submarines to pick up these little nodules off the ocean floor, and you couldn't really ask for a cleaner way of mining, interestingly. That was the argument. Greenpeace isn't buying it, and interestingly, there is a conference that is happening, and it actually started yesterday on March 18th. The International Seabed Authority is meeting, and it looks like there is going to be some resolution on this mining code for the deep sea. And so this is interesting here. And there was a story in the Northern Miner in late February. Deep sea mining seems to be inevitable, says ISA chief. And what a change this is within a year. A year ago, it was still seen as a little bit of science fiction. Here, the story by Bruno Venditti suggests that the ISA is realizing that if they don't get on top of this, it's going to happen anyway. Here is the story by Bruno Venditti at northernminer.com. Deep sea mining is likely just a matter of time, according to the head of the International Seabed Authority, or ISA. Quote, clearly now we are reaching a very high level of interest, so I would say that yes, it seems to be inevitable. Michael Lodge, the Secretary General of the ISA, in an interview with CNBC, said on Monday, quote, one of the main drivers of industrial interest is the potential to produce large quantities of minerals at equivalent or lower cost to what can be produced on land. Very interesting. So they are meeting in Kingston, Jamaica as we speak, and it'll be interesting to see what kind of results they get. Now, the story also came out as the meeting began on March 18th, just yesterday, and this is from mining.com. UN deep sea mining body considering expelling Greenpeace. Very interesting. The representatives of 167 countries at the International Seabed Authority will discuss this week the possibility of the expulsion of Greenpeace from the UN deep sea mining body, the BBC reported on Monday. Greenpeace activists in late 2023 disrupted a research exhibition when they boarded Sea Explorer, the metals company's vessel in the remote Pacific. 5 Greenpeace activists boarded the MV Coco on November 25th and disabled its A-frame hoist crane. So interesting there, and we actually have a press release that came out from Greenpeace the same day. And here's the headline, Stop Deep Sea Mining, Not Protest. Greenpeace demands regulator. And so this is the Greenpeace response. Governments gather to debate deep sea mining amid growing public resistance as the 29th session of the International Seabed Authority starts today in Kingston, Jamaica. The meeting is a critical moment for the future of the oceans as deep sea mining companies are pressing governments to agree on a mining code that would legitimize this destructive practice. So it's quite interesting. Ultimately, Gerard Barron, if we're to take him at his word, he very much saw himself as an environmentalist. Again, the chief executive of the metals company, TMC. And it's interesting here, Greenpeace is not buying it, and they are saying that ultimately this is going to hurt the environment, and that this whole idea of kicking Greenpeace out of the ISA is misplaced. So interesting debate. So there should be some news coming out here, one assumes, after this meeting takes place. And the meeting is from March 18th to 29th. So we got a couple of weeks before that happens. So that is happening. Now, taking a different perspective here, we have a story from the South China Morning Post. China is planning to break its dependency on Australia and Brazil for iron ore, and Africa is the key. So just as the US and the West are trying to get independence in their supply chains, China is doing the same thing. And again, trying to wean their dependency on Australia and even Brazil, right? A member of the BRICS, and Africa is seen as the key. And just a couple of lines from this article, China has a number of iron ore projects in the work in Africa as part of its foundation plan to de-risk its supply of the mineral. For now, the country relies heavily on Australia and Brazil, which supply the vast majority of the world's iron ore. And so, interestingly, as a side note, iron ore actually dropped precipitously again and recovered to $110 a metric ton. So down again. And again, iron ore, the main input in steel, is often seen as a kind of gauge on the global economy, particularly China, because of its role in infrastructure. Again, when we think of an infrastructure build out from the US, from Joe Biden, think steel, think iron ore, think BHP, Glencore, Vale, and Rio Tinto, for example. Now, conversely, we had this other story from Reuters via mining.com, Africa to play, quote, huge role in U.S. critical minerals strategy, says Treasury's number 2. So we're getting the South China Morning Post on one hand. And when did this come out? Let's just get a date on this. This is March 16th. And the Reuters article is March 14th. One almost wonders if the South China Morning Post was a response to this article that came from Reuters. Who knows? But they're both saying Africa is our plan. So let's take a very brief look here. The United States is looking to Africa to help loosen a Chinese stranglehold on battery metals and reduce Russia's influence over the market for other minerals, U.S. Deputy Treasury Secretary Wally Adeyemo said on Thursday. And there is a quote here from Adeyemo, who told Reuters during a visit to a platinum mine in Marikana, South Africa, owned by Sibanye-Stillwater, quote, "We don't want to be overly reliant on any one country or any one company for global supply chains for critical minerals. Africa is going to play a huge role. A lot of critical minerals are located here." And finally here, the article says Chinese assets in Africa include massive copper and cobalt projects in the Democratic Republic of Congo and Zambia. We've been discussing the copper belt there, as well as the cobalt and coltan that is in the eastern side of the DRC, which we're going to get into in a second here, as well as Chinese have interests in lithium in Zimbabwe. And remember, Zimbabwe from last week is where the U.S. officials were sent out of. Remember that? And the State Department put out a press release saying, you just ejected in a very dangerous way our, democratic institution workers, this sort of thing. And then the government of Zimbabwe basically said they're trying to overturn our government. So there's lithium there in Zimbabwe and big Chinese investment. So again, the battle for Africa is getting very real. So speaking of that, we have another update here, and this is on Niger, which has the military junta, where there is the massive U.S. drone base, a $110 million drone base. Now, in the last week, the government of Niger has announced that they are no longer cooperating with the U.S. military and that they see the flyovers as illegal. There's no permission. As it says here, in thehill.com, Niger ordered U.S. troops to leave after Biden officials warned about ties to Russia, Iran, and this is according to the Pentagon. Now, interestingly, I watched this video on YouTube that the Niger government released, and what's very interesting about it is it seemed like their biggest issue was the quote-unquote condescending manner in which the U.S. were dealing with them. They said they ignored all the usual diplomatic formalities, they just announced it with no written announcement and basically said, we're coming over and we're going to talk to you about what's going on here. And they really disliked how they were treated. And what's interesting about it is it's kind of back to this idea of the importance of soft power and building goodwill. Because again, when you watch that video and you read the speech carefully, you really do get the sense, and they use the word condescending, you get the sense that they felt insulted by the way they were treated on things that had nothing to do with natural resources or power or anything, just on the way that they were directly dealt with, right? Soft power. So interesting there. And of course, don't forget Niger and uranium. Remember the Iraq War, where there was concern about yellow cake uranium coming out of Niger? Right? So it's all coming full circle here. And now, as supplies of uranium potentially get more constrained, one could see also a geopolitical issue there with the uranium resources in Niger. What if Niger does ally themselves with Iran and Russia and China? Pretty interesting development there. And of course, there's Global Atomic, which is based out of Niger, a company we've been following at the Northern Miner for more than a decade here. They put out a press release. Global Atomic Corporation reports that the Republic of Niger announced its intention to terminate its military cooperation agreements with the United States, which has a large military base in Niger. It remains unclear if withdrawal of U.S. troops will be required by Niger, as the U.S. military base is used to patrol a large section of the Sahel region beyond Niger's borders. And we have a quote from Stephen G. Roman, president and CEO, who of course has been interviewed in the Northern Miner newspaper repeatedly. Quote, with the situation in Niger being fluid, in addition to current advanced discussions with project lenders, the company is also pursuing other financing strategies to meet its project funding requirements. Given strong third-party interest in Global Atomic's high-grade uranium project and our plans for near-term production, there are many groups interested in funding the DASA project. The company will assess these options, monitor events in Niger, and keep shareholders appraised. So interestingly, as we saw with Barrick, B2 Gold, and many more, mining companies, as Mark Bristow says, we ignore geopolitics. And you see that they have to, just out of pure pragmatism. Otherwise, they lose their projects. So, interestingly, Global Atomic continues working in Niger. Now, interestingly, also, Nigeria, which is just below Niger, they've reopened the border with Niger. It was closed after the coup, and there was all the threats that ECOWAS was going to go in. It never happened. And now Nigeria is facing quite a few problems here. They have a security crisis in the north, with another 87 people kidnapped. Last week, it was something like 200 women and children kidnapped. They have a major security problem there. And meanwhile, they have an inflation problem, which seems to be about 30%. And as far as I understand the definition of hyperinflation, I believe it is 100% a month. So theirs is 30% a year. So they are not in hyperinflation, but psychologically, they seem to be on the path, don't they? And again, the court ordered Binance to give them more data on what's going on with their top traders in Nigeria. Again, a classic crypto country here. And just to wrap up on this then, Nigeria, if you're wondering, I asked ChatGPT, what are the main natural resources? Oil and gas, interestingly, and then coal, tin, and iron ore. And interestingly, they are the largest economy in Africa. So they are important, and it seems like that country is getting destabilized through both security in the north and inflation across the country. So something to watch there. Now, finally here, let's move down back to the DRC on the eastern side of the DRC. Threat of regional war intensifies as Democratic Republic of Congo rebels close in on Goma. So this is the Financial Times, and there continues to be concern and intensification of the threat of regional war in the eastern DRC. Aid agencies warn of humanitarian catastrophe as resurgent M23 militia fights its way through the mineral-rich region. And the mineral, of course, as I asked ChatGPT here, the minerals that they have in the eastern DRC is coltan, which is also known as columbite tantalite. North Kivu, where the fighting is a major source of coltan, which is processed to produce tantalum. Tantalum is used in the manufacture of electronic components such as capacitors and high-power resistors in mobile phones, DVD players, video game systems, and computers. When they're talking about mineral rich, it is coltan, which again is used to produce tantalum. Also interesting. And finally here, just a couple of paragraphs from this FT story. The capital of one of the Democratic Republic of Congo's most mineral-rich regions is being asphyxiated as armed rebels close in on the city in a conflict that threatens to explode into a wider regional war, aid agencies and analysts have warned. As fighting between M23 rebels and DRC government forces intensified around Goma, capital of the eastern province of North Kivu, the situation had become, quote-unquote, really catastrophic, said Angel Dikonge, a Tangana, DRC country representative for UNHCR, the UN Refugee Agency. M23, which observers say is being backed by neighboring Rwanda, has fought its way to within 25 kilometers of Goma, which again is in North Kivu. The rebel groups control almost all supply routes into the city, where the 1.5 million strong population has been swelled by hundreds of thousands of displaced people, sending the price of basic commodities rocketing, according to aid agencies and analysts. It's almost like a siege by trade routes. More than 230,000 people fled Goma in February alone, according to the UNHCR. The encirclement by M23 was, quote-unquote, asphyxiating the city. Also, the intensity of fighting was, quote, completely unprecedented, said Joachim Jaminardi, advocacy advisor at the Norwegian Refugee Council. Quote, if the fighting gets closer to Goma, the impact is going to be exponential, end quote, as civilians would run out of food and anywhere to flee. So the eastern DRC continues to be a crisis here. And finally, just a couple of headlines here. UN chief condemns attack on peacekeepers in DRC. So there are UN peacekeepers there, and they are being attacked. So that is your brief update on what is happening out there in the last week. This episode, we have a wonderful show with the great Rick Rule, investor and speculator and former CEO of Sprott US Holdings. And it is an extended interview. I really grill Rick, and he gives great answers and very interesting answers. I learned a lot. And again, Rick is just a great sport, and that is always appreciated. And also coming up, we have a wonderful CEO spotlight with Dundee Sustainable Technologies President and Chief Executive Officer Jean-Philippe Mai, who discusses all of the innovation that Dundee Technologies is doing in order to help provide more environmental and efficient processing on mine sites. So a wonderful show ahead of us, news, stories, and medals. If you want to find us online, you can find us at northernminer.com. You can find us on Twitter at northernminer, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Jean-Philippe Mai, President and Chief Executive Officer of Dundee Sustainable Technologies, for this week's CEO Spotlight. Joining us today, I'm very pleased to welcome to the Northern Miner podcast, Jean-Philippe Mai, President and Chief Executive Officer of Dundee Sustainable Technologies. Jean-Philippe, welcome to the show.
Hello, Adrian. Thank you very much for having me. I'm happy to be here.
Well, I'm thrilled to have you on the show. It sounds like you're up to very interesting things at Dundee Sustainable Technologies. Of course, ESG metal is I call it a white hot topic right now. Tell us a little bit, though, people have heard of Dundee and the mining industry. Tell us a little bit about Dundee Sustainable Technologies and what you guys are up to.
Well, at Dundee Sustainable Technologies, we are a company which has been majorly controlled by Dundee Corporation, which is our majority and controlling shareholder. So we're part of that broader Dundee Corporation family. And at DST, Dundee Sustainable Technologies, we really have been focused on the development and now commercialization of novel metallurgical processes for the mining industry. So for over a decade now, we've been really focused on the development of new processes ought to bring efficiency in terms of the metal recovery processes and the overall processing approaches. So we really now have two processes which we are commercializing. We have our Clever process, which is a gold extraction process, which uses sodium hypochlorite as an alternative to cyanide for gold extraction. So the process operates in a fully closed loop, has no liquid effluent, very fast kinetic. So typically within 1-2 hours contact time, we have gold in solution and operating at ambient temperatures and pressure. So really that was our first process which we've developed. And of course, when you're developing a novel gold extraction process, people always send you their worst material. So we came to deal and faced with a lot of refractory arsenopyrite gold ores. And when we were treating arsenopyrite gold ores, we were deconstructing the arsenopyrite sulfide matrix and left with an arsenic product, which really needed to be stabilized. So this is what forced us to develop our second process, which is our glass lock process, which is essentially the removal and stabilization of arsenic using vitrification. So we can take most and any arsenic product and permanently stabilizing it using vitrification. So now both of our processes have been demonstrated with industrial demonstration plants. We have one in Tetford Mines, Quebec, here, which is halfway between Montreal and Quebec City. And we have our Glasslock industrial demonstration plant, which is on site and operating copper smelter in Africa. So both processes have been demonstrated industrially, and now we're actively commercializing our processes.
Very interesting. And again, so topical in this current environment and conversation of, ESG metal. So with that, then, how does it measure, in a sense, in terms of energy? And you mentioned efficiency before. Like, can I be both environmental and maybe do better as far as my processing is concerned by using these products?
Yeah, well, the angle and the approach was always to look at how do we optimize and how do we innovate? And for us, innovation really is a mixture of efficiency, viability, and environmental sustainability. So you really need to hit all three to have a good and proper innovation. So in terms of our gold process, the clever process, cyanide's been used for decades and it works well. But there's other regions which are very efficient at putting gold into solution. So in our case, we use a mild concentration of sodium hypochlorite with a catalytic amount of sodium hypobromite. So in other words, we use a low concentration of your typical household bleach to put gold into solution. And the kinetics are very rapid. So within 1 hour, 2 hours, you have gold in solution. So in terms of efficiency, the contact time is much shorter than the traditional 24, 36 to 48 hours. So there's definitely a gain in terms of kinetics using the clever process. And then the fact that we're operating in acidic condition, typically pH 1, 1.5, this provides an additional chemical grinding, which dissolves a little bit more of the ore matrix and allows for increased gold recovery. Typically on the same material, we'll get 1 to 3% additional recovery using our process. And then when we're operating under a sodium hypochlorite environment, it's very important for us to recover all of our regions. So we use a membrane-less electrolysis cell and completely regenerate our sodium hypochlorite. So in this fashion, we do not have any liquid effluent. So we're closed loop in terms of all of our regions, and only dry stackable tailings are generated. So when you're looking at it from an overall processing approach, this allows for both efficiency in terms of kinetics, but also in terms of footprint and the fact that you operate in a closed loop. So that's one aspect. And with regards to glass lock, vitrification is a very efficient way of transforming a toxic element such as arsenic into an insoluble product. So the novelty that we're presenting and offering with Glasslock is the fact that we're able to incorporate high amounts of arsenic within an insoluble glass matrix. And this has really been an innovating step, as we all know that arsenic volatilizes at low temperature. And in our process, we're able to form an intermediate compound which is stable at the melting temperature of glass. So this allows us to incorporate high amounts of arsenic into this insoluble glass product, which meets environmental norms and very efficient in terms of dollar per ton of arsenic compared to other approaches.
Very interesting. So, if you can boil it down then and simplify it for us, if I'm a mining executive and I'm listening to this, and I assume this is more directed towards people who are producing metal, which they need to be processed and extracted, or boil it down for us, why should I try this? What's the simple benefit that I'm getting here if I try one of these two products?
The value here is we're really offering an alternative and options. So I think for any project developers or operators which are struggling or facing some more refractory material or drop in recovery, I think doing some trade-offs on alternative process is key to really seeing the impact of changing the processing circuit on the project. Our process is vastly different. The chemical, the pH, the conditions are different. So we know you need to do some test work to define what is the achievable recovery. If you're adding a few percentage to your project, what is the impact on the mine plan? If you're reducing footprint, what could be the impact as well? The fact that you do not need tailing ponds, the economics on the overall project of changing something that important as the extraction and recovery circuit, really deserves a trade-offs. And I think, we're like any developing project, you need to do some test work. We like to speak with numbers. People send us the samples of their ore. We do some diagnostic testing, get to define what is the achievable recovery. And then you go into more optimization, test work, optimizing the processing condition. And then you can do some preliminary engineering and some sizing and costing to see if this is good for a given project. So really what we're offering is an alternative, and asking for project developers and operators to be curious and to try us, to look at what our process could bring in terms of project dynamics and cost.
Okay, excellent. And so if I wanted to contact you then, In a sense, what is the process here? Would I reach out to the website and would I be sending, eventually is the process, I would send some ore from my project? Like, let's say I want to act on this. What should I do?
Yeah, we're easily reached. Anyone can go to dundeetechnologies.com and find us via either phone or email. And typically, we like to engage with people. We want to learn about their project, see what type of material and ore that they're looking at or developing. But we also want people to understand how our processes work. We're not a black box. Adoption goes through understanding. So we like to engage into, initial and preliminary discussions so that both parties understand our process and we understand the project and the ore, and we can discuss right away if we believe that we can add value and if it's worth doing some test work. And then after that, we can coordinate for companies to send us a sample, and then we do some diagnostic tests and go from there.
Beautiful. Jean-Philippe Mai, President and CEO of Dundee Sustainable Technologies. Thank you for joining us on this week's CEO Spotlight.
Thank you very much, Adrian. Pleasure being here.
And thank you once again to Dundee Sustainable Technologies for sponsoring this week's episode of the Northern Miner Podcast. If you want to find them online, just go to dundeetechnologies.com. Turning to the website, Wailu says industry will turn from LME without green nickel. This is Reuters via mining.com. So we have been seeing Wailu owner Andrew Forrest make the case for green nickel as nickel is oversupplied from Indonesia. Let's take a closer look at the story. Nickel miner Wailu, owned by Australian mining magnate Andrew Forrest, said that if the London Metal Exchange doesn't launch a green nickel contract, the industry will have to look for another trading venue. Forrest had told Australian media last month that the LME should classify its contracts into clean and dirty to give customers more choice. Wailu is set in May to shutter 2 nickel mines in Australia that it bought last year for $500 million. The LME said that low-carbon nickel, which it classifies as producing 20 tons of carbon dioxide or less per ton of nickel, could already be traded on its partner Metal Hub's system. And here is a quote from Wailu CEO Luca Giacovazzi, who told Reuters, quote, Wailu has been contacted by several parties seeking to develop a green nickel premium, so there is clearly demand for greater transparency and differentiation between clean and dirty nickel. As the world's largest metals exchange, the LME should be leading in this area. If the LME is to continue to set the standard for ethical metal supply practices, it cannot afford to take no action, or the industry will look for an alternative marketplace. Now, let's not forget who owns the LME, which is Hong Kong Exchanges and Clearing. So, if this whole green nickel thing is not to the advantage of China, one wonders if that maybe is part of what is going on here. Hard to say, pure speculation. I asked Rick Rule about green metal in our interview coming up as well. Continuing on, U.S. must improve copper mine permitting process, according to the Freeport-McMoRan CEO. This is Reuters via mining.com. The U.S. must improve its mine permitting process if it hopes to boost domestic supplies of critical minerals to power the clean energy transition, the CEO of copper giant Freeport-McMoRan said on Monday. And we have a quote from Richard Adkerson, who told Reuters on the sidelines of the CERAWeek Energy Conference in Houston, quote, the U.S. government needs to stop giving lip service to permitting. The question is, given our political system that we have today and the dysfunctionality of it, how do you go from getting a project verbally accepted to getting actions done? Earlier, U.S. Energy Secretary Jennifer Granholm told the conference that she supported efforts in the U.S. Congress to reform the country's mining laws, some of which were first approved in the 19th century. Adkerson sat next to Granholm at the conference's Monday lunch and said he had a productive conversation with the secretary about permitting reform. So much of this sector, it's just all about education. Once you know what's going on, it's almost, I don't want to say it's nonpartisan, but it becomes much easier. And you do get the sense that maybe Jennifer Granholm is really learning about the resource sector. So maybe grounds for optimism here. And then finally, Adkerson said, quote, we're not talking about dropping standards, we're talking about processes here. So interesting story there. Copper prices hit a new 11-month high with global rate policy focus, and we're going to see that in metal prices. Quite a jump in copper. This is Bloomberg via mining.com. Copper hit a fresh 11th-month high in London, tracking a rally in U.S. equity markets at the start of a busy week for global central bank policy. And of course, we had the hotter than expected inflation number. I believe it was PPI that came out last week. Prices climbed as much as 1% to $9,164.50 a ton on the LME, recovering from losses seen earlier after mixed economic data from China. Copper surged last week, ending a months-long spell of inertia as investors honed in on risks to supply at mines and smelters, along with a generally more positive global economic outlook. So copper breaks out strongly above $4 a pound. Again, we're going to see that in metal prices. Copper price surges on supply threat as iron ore shows economic risks. Indeed, and this is exactly what we've been commenting on here. And this is Bloomberg News via mining.com. Prices for two of the world's most important mined commodities are diverging quickly, with copper rallying above $9,000 a ton as supply cuts hit the market and iron ore sinking as demand headwinds mount. This is a very interesting divergence. Copper has surged 5% this week, ending a months-long spell of inertia as investors hone in on risks to supply at mines and smelters. But signs of the headwinds in traditional industrial sectors are still plain to see in the iron ore market, where futures fell below $100 a ton for the first time in 7 months on Friday. Investors are betting that China's years-long property crisis will run through 2024, keeping a lid on demand. So interesting, copper up, iron ore down. Which one should we be paying attention to? And continuing on, another update on the copper smelters in China. China's copper smelters vow capacity controls after fees plunge. This is Bloomberg News via mining.com. China's copper smelters pledge to control capacity as the industry responds to a tightening in the global concentrate market that led to processing fees falling to near nothing. Executives from 19 smelters have agreed to rearrange maintenance work, reduce runs, and delay the startup of new projects, the China Non-Ferrous Metals Industry Association said in a statement following a meeting in Beijing on Wednesday. The group stopped short of outright production cuts, and the statement didn't give details on the scope of the adjustments. So interesting developments in the copper market there. Continuing on, China to invest in Canadian mining despite crackdown, Envoy says, and this is Bloomberg News via mining.com. China's ambassador says the country will continue to do business in Canada's domestic critical minerals sector despite Prime Minister Justin Trudeau's unfortunate crackdown on foreign investment. And we have a quote from Ambassador Kong Peiwu, who said in an interview with Bloomberg News, quote, politicizing normal commercial cooperation and using national security as a pretext for political interference is wrong. China has expressed firm opposition to this. We'll continue to do business on the basis of mutual respect and mutual benefit. And again, we saw that last week, where the U.S. was considering using national security as a reason to keep BYD, Build Your Dreams, out of the U.S., citing data is a reason. Continuing on, Northern Dynasty takes EPA's Pebble veto to court. So the soap opera continues here of Northern Dynasty. This is by Jackson Chen on northernminer.com. Northern Dynasty Minerals shares dropped on Friday after it said it filed 2 federal court actions over the government's moves to prevent it from building a mine at its Pebble project in Alaska. So the battle continues there, interestingly. And so not giving up. Another headline here, BHP stands down 25% of nickel project workforce, and that was Bloomberg News via mining.com. Another story from Bloomberg via mining.com, the big lithium short gets dangerous on lower supply outlook. So, of course, we saw lithium fall through the floor in the last few months, and now, as we're going to see in metal prices, it is starting to perk back up. And just a couple of more headlines here. Argentine court in key lithium regions halts new permits over environmental concerns. This is Reuters via mining.com, and one wonders if this is the reason that lithium perked up. An Argentine court in the northwestern province of Catamarca has suspended the issuance of new mining permits, demanding fresh environmental impact studies be carried out, looking at local lithium projects, a judgment seen by Reuters showed. So a court has halted new lithium permits in Argentina. So those are your news stories. Now let's take a look at metal prices. Turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.32%. That is 0.22% higher than last week. And again, off of those higher than expected inflation numbers from last week. The UK 10-year gilt is yielding 4.08%. That is 0.11% higher than last week. And the Italy 10-year bond is yielding 3.69%. That is 0.07% higher than last week. So bonds perking up a bit there. Turning to precious metals, gold is trading at $2,155.60 per ounce. That is $27 lower than last week. Silver is above $25 at $25.10 per ounce. That is 44 cents higher than last week. So gold lower, silver higher. You could argue silver playing catch up here. Platinum is trading at $917.40 per ounce. That is $22 lower than last week. And palladium is trading at $1,031.79 per ounce. That is $2 higher than last week. Turning to industrial metals, copper is trading at $4.12 per pound. That is 20 cents higher than last week. So big move in copper. Iron ore is trading at $110.47 per metric ton. So that's $3 lower than last week, which was already low and I think had gone below $100 we were reading there intra-week. Interestingly, turning to aluminum, aluminum is trading at $1.03 per pound. That is a penny higher than last week. Lead is at 96 cents per pound. That is a penny higher than last week. Nickel is at $8.12 per pound. That is 4 cents higher than last week. And tin is above $13 at $13.01 per pound. That is 48 cents higher than last week. Cobalt is unchanged at $12.95 per pound. Lithium is at $15.77 per kilogram. That is 66 cents higher than last week and continues the upward climb from the low a month ago at $13.27. So lithium gathering some momentum. Uranium is trading at $91 per pound. That is $2.50 lower than last week. So continuing to consolidate. And zinc is trading at $1.15 per pound. That is a penny lower than last week. Zooming out, it's a tale of many markets here. Rather than everything moving in unison, we're seeing interesting moves in individual markets. We're seeing it in copper with the very big move of 20 cents on the week. We're seeing it in silver, perhaps playing catch up to gold, now above $25 per ounce. And we're also seeing it in lithium, which seems potentially to have bottomed a month ago. So very interesting move there. And uranium should be noted at only $91, having been in our previous readings here as high as 106. So uranium at best consolidating. And those are your metal prices. Coming up, I'm very pleased to welcome to the show Rick Rule, investor, speculator, and former CEO of Sprott U.S. Holdings. He is one of the great interviews of this industry. Almost everybody who has been involved in this industry knows who he is. It was a joy to be able to ask Rick all the questions I never get to ask when I'm listening to him on YouTube. He was very gracious with his time. We cover many topics here. I hope you enjoy it, and I will see you on the other side. Very pleased to welcome for the first time to the Northern Miner podcast, while I have been host, Rick Rule, investor and speculator and former CEO of Sprott U.S. Holdings. Rick, welcome to the show.
Thank you. It's a particular pleasure. I've been a reader and beneficiary of the Northern Miner for 5 decades, so I'm delighted to be here with you.
Well, you might be one of those legendary readers of ours who, when we removed the stock prices a few years ago, there was a general panic in our audience. Did you notice that, just out of curiosity?
I didn't, actually. I had other sources of quotation. But, you know, it brings up an interesting point of discussion. People are slavishly interested in price information, and they spend absolutely no time at all ascertaining value. If you don't know what something is worth, what does it really matter what it's selling for? The price, in the very near term at least, is a floating abstraction. And frankly, it left more room in the Northern Miner for paradigm and information, which was of more use to me. So I'm delighted that you dropped the prices.
Well, isn't that interesting? I could see this whole interview becoming one massive tangent. But before we jump in, Maybe just expand a little bit on what you're saying. So in other words, say for myself, when I'm in my little investments, there's nothing I enjoy almost more than at the beginning of my day with a cup of coffee and looking at the prices and looking what happened and how rich I may be becoming. Do you approach this differently?
Very differently. I very seldom look at price quotes. I don't think that price information has much use to me if I don't understand the delta between price and value. If a stock is selling for $1 a share, what that's suggesting is that one person thinks it's worth $1, somebody else thinks it's worth $1.05, and there hasn't yet been a meeting of the minds. Whether or not I want to use that dollar bid to sell or that $1.05 to buy really depends on what I think the underlying company is worth. Let's say there's 25 million shares. So the market is suggesting that the company is worth $25 million. What do I think it's worth? Is $25 million a good price for that business? Is it too high? Is it too low? If I think $25 million is too low, I'll probably buy a bunch of stock. If I think it's too high, I'll probably sell the stock I have. But the point is that the market, too many people regard the market as a source of information. The market is really a facility for buying and selling fractional ownership of businesses. And if you don't have an opinion as to the value of the business, I'm not sure whether price information is of any use at all.
You know, it's very interesting and it's a profound point. I guess my only final little follow-up on this before we jump into what happened at PDAC, how do you know when you're wrong then? I mean, so you have a sense of what the value is. Do you ever feel like, I got it wrong in terms of value and then have to, I assume you're not 100% on your trades, right? So how do you know when you're wrong?
No more than monthly, Adrian. The truth is that you make mistakes, but the reality of, in particular, speculation is that you're wrong more often than you're right. The wonderful arithmetic of speculation, however, is that the most you can lose being wrong is 100% on a trade. Much more commonly, you learn you're wrong early enough that you can limit your losses to 25, 30, 35%. When you're right, it isn't impossible. In fact, it isn't infrequent that you can make 1,000% on a trade. And if you have one 10-bagger, 1,000% win, that amortizes an awful lot of 25 or 30% losers. So the truth is, in the speculative part of my portfolio, I'm not infrequently wrong, but the winners have more than amortized the losers over the course of my career, partly because when I'm wrong, I admit it and I sell the stock.
And how do you know, though? Is it the price information? Is it the news has changed? Just to drill down a little bit, like how do you know when you're wrong? And maybe you don't.
Well,
I mean, sometimes you might sell it and then...
Let's talk about exploration as an example, Adrian. Exploration really is a process by which the management team is answering a series of unanswered questions around a thesis which would add value to a property. Perhaps they have a surface expression that's been established by grab samples. And the first question is the character and consistency. And it might be that they propose to answer that unanswered question with a systematic trenching grid to determine the unanswered question is, do we have a drill target? Do we have a consistent distribution of mineralization? And does the mineralization go through the till all the way down to the topsoil? Answer, yes or no. You're defining the target. So let's say now that this systematic grid has worked out. And in fact, you have reasonably consistent distribution, and it isn't merely transported material in the till, but goes down, in fact, to bedrock. Now the question becomes, does it extend into the bedrock? So you might do a 3 or 4 hole drilling program. That's the unanswered question. Is the mineralization consistent, or is it some sort of surface scab? Then the question might become, the next unanswered question, does the surface anomaly reflect itself in the subsurface anomaly? In other words, now we're starting to look for that combination of tonnage and grade. At any point in time, if rather than getting a yes answer, I get a no answer, clearly I sell the stock. If I get a semi-yes answer, which is to say that the information that I get from the exploration program is semi-successful, but it doesn't meet the sort of size parameters or the grade parameters, if it doesn't meet my expectation as to the apparent value at this stage in the company's genesis, I sell the stock.
Okay, beautiful. Thank you for actually really giving a very practical answer. In a sense, you're saying there's objective results that we can get from, as far as if we take the, excellent example, our bread and butter here, exploration, whether you are right or wrong based on results. So super interesting. And one final question before we actually, semi-begin this interview. Hearing all this wrong and right, I think of that great James Dines expression, you have to look wrong to be right. And so did you ever meet James Dines? Do you have any James Dines stories for us?
I knew James Dines very, very, very well. I met him first in the latter part of the decade of the 70s when he mostly rightly described himself as the original gold bug. I spent an awful lot of time with James Dines. He was very interesting to me because he thinks very differently than I do. He thought price and momentum were everything. He famously said, don't think, look. In other words, pay attention to market information, and I pay attention to valuation. So I particularly enjoyed my time with James Dines because he operated in a different part of the world that was very interesting to me. Of course, as a younger man, the fact that he owned a modeling agency and always had between 2 and 4 young attendants also increased the attraction of his booth.
Indeed. He's the reason I'm speaking to you today, in the sense that I had heard an interview with him when I first started getting interested in gold, and I took the fateful leap of spending $500 on his subscription back in 2010, where he called the rare earths correctly, one of his many brilliant calls. And I was hooked from then on. I don't know if it's ever been as good for me. Classic beginner's luck there. But it's great to hear and very interesting that you spent a lot of time with them. I feel like we could do an entire interview on James Dines and your experience with him.
At any time you wish, I'll do that interview. I got to know him very well, and I was very fond of him.
Maybe a summer interview. There's an idea. Okay, let's get into the business at hand here. Did you go to PDAC in Toronto? And if you did, what was your sense of the conference?
If you're a mining investor and speculator and you don't go to PDAC, you've wasted a week. It is the only conference of its kind on the planet. It is, I would say, the granddaddy of all mining, particularly mining investment conferences. The short courses, the companies, the speakers, you just absolutely, positively have to go if you're serious about doing this. And so, yes, I absolutely attended. I presented on 4 different occasions. I had a lot of meetings, which were at least of interest to me. Wouldn't miss PDAC.
Very interesting. And what is your sense then of exploration as a business right now? I mean, we're hearing a whole lot about how the explorers are not able to raise funds. There's even talk, I was talking to Ron Birnbaum of Peartree, who was saying the flow-through share structure may be at risk. What is your sense then of the health of the business? Is this something you've seen before, and really it's just being put on a new front page, so to speak, but it's a kind of an old story?
Well, you've asked a lot of questions there, and my answer is going to really anger your advertisers and exhibitors. I think the junior industry is, and has been for my entire career, and will continue to be, overfunded. I suspect that if you merged every junior company in the world, let's say there's 3,000 of them, into one company, Junior Explorco, that company in a very good year would only lose $2 billion. And in a bad year, it would lose $10 billion. So what is that company worth, Adrian? Is it worth 8 times losses, 12 times losses? In a bull market, 20 times losses? That simple statement ignores the fact that maybe 5% of the issuers generate enough performance that they add legitimacy and sometimes luster to the sector. The juniors say they're having a hard time raising money. But I'm sure that if you pulled a statistical sample of TSXV juniors below $50 million market cap, that what you would find is that the sector as a whole spends almost 50% of capital raised on G&A. That's unsustainable. There are too many listings. Further, the terms that are on offer for the private placements still haven't returned to the terms that were on offer in the late 80s and early 90s, and then again in the late 90s, and then again in the earlier part of the decade 2010 to 2020, which is to say, specifically with regards to private placements, there is no longer very often the mention of a warrant. The only reason why an investor might participate in a private placement is so that the capital that he or she introduces to the company can be used for some potentially quantum improvement in the affairs. If you get restricted stock, if you are contributing to the advancement of all shareholders, it has been common in venture capital investing that you get a warrant, that you get a way to potentially increase your exposure after the fact for taking a risk with restricted stock. And warrants have very seldom been offered. Now, Adrian, the management will say, well, I can't do that because a warrant is dilutive. If a warrant is dilutive, what's an option? The only difference between a warrant and an option is who gets it. There hasn't been any hiatus in option issuing as a consequence of a poor market, only a hiatus in warrant issuing. So I would argue once again that the sector is in fact overfunded relative to its performance in generating cash for shareholders. And I would argue too that the median deal terms on offer in the TSXV are not, in a historical sense, desperate, even fair. So I would argue that the industry continues to be over rather than underfunded.
A fascinating contrarian view as we come to expect from you, Mr. Rule. Okay, let's say I say, fair enough. Maybe you're onto something. You probably have more experience in this sector as an investor than most people. You've hung out with James Dines and spent a lot of time with him. So that all being said, from, let's say, a Canadian politician is listening to this and they're going, well, what should be done then? I mean, if it's overfunded, how do we get do you have an answer as far as the exploration sector and what to do? Because right now you're saying, actually, they have too much money. So what should be done?
Well, if you ask me from the point of view of a politician, what I would prefer that the politician did was resign. Let's make that plain. I'm from the government. I'm here to help. It is not something that I consider fondly. I think that the industry and the investors are the authors of the sin. People in government do what they do. The famous American journalist Mencken described elections as advanced auctions of stolen property, and that's sort of how I feel about government. So continuing in that vein is probably a dry hole. I suggest that the fault lies with the investors. And I suggest that to the extent that investors became more educated and employed the process of education more, rather than say the old dictum, got a hunch, bet a bunch, that the industry could restore itself to financial health very quickly. I would ask investors, too, to pay attention to the fact that most of the people who start and run small public companies have no track record of success. But there is a small subset of issuers who are serially successful. The first thing that you can do is hang around with the second group, the serially successful, and avoid the first group like the plague.
Interesting. So an emphasis on team, it seems. But just to back up, though, I mean, again, I'm kind of still wondering, what should be done? Because there's almost this disconnect, right, between the companies that are saying, hey, how are we supposed to explore and find the metals that the world supposedly needs? But they have no money to do it. So do you have any kind of big picture thoughts on how to solve this situation? Should BHP was putting a contest out to invite startup explorers to submit? Is that one thing? What do you think should be done?
Well, I think the major mining companies are probably the best investors out there. That isn't to say that they don't make mistakes, but at least they do their own due diligence. My argument is that there are too many companies. My argument is that too much of the so-called exploration budget worldwide, but particularly in Canada, goes to G&A.
What is G&A?
General and administrative expense. Money that goes to all places other than in the ground. About 20 years ago now, we had a young intern that worked for us. And I made this intern collect 5 years of financial statements, quarterlies, balance sheets, cash flow statements, statements of operation. And I asked him to look for positive and negative financial trends. He reported back to me in 2 weeks that he couldn't find the positive trend that I was looking for, but the negative trend was evident. And I asked him what that was. Pulling 25 companies, he found at random that the median of the 25 companies spent over 60% of capital raised on general and administrative expense. If you cut the exploration expenditure, or rather the exploration raise in Canada, by 25%, but eliminated 75% of the companies, so that more of the capital that was raised in Canada, ostensibly for exploration, went into exploration and less of it went to G&A, you would have a much healthier industry. There are too many lifestyle companies out there. There are too many companies that are led by the lame, the halt, and the blind. The sector really needs the Darwinian forces to make it efficient, and it's not efficient.
Fascinating. So almost to your earlier point, you're saying there is enough money there. It's just that the way it's being administered towards G&A, as you put it, they're not spending it properly what they have.
Pretty clearly, if the industry spends $2 to $5 billion a year more in capital raised than it generates in projects sold, or heaven forbid, profits and dividends, there's too much money. Every year at PDAC, the story's the same. Send new money, old money all gone.
Right. So almost to my earlier point, this is a story, in a sense, you've heard before. And in a sense, you're not buying it.
I've watched it. I get pitched probably 2 times a day, let's say 250 working times a day. So I get pitched 500 times a year. Of those pitches, there's probably 75 I would like. And of the 75 I would like, there's probably 25 that are intelligently priced. That means at the top of the funnel, there's 500 entrants. And at the bottom of the funnel, there's 25 transactions. That tells you a lot about my opinion as to the valuations in the market.
Okay, excellent. Now, there's something I've been calling the Rick Ruleization, because I know you're a good sport. What I call the Rick Ruleization of the mining sector to a certain degree. And I think it's kind of slightly unfair because I think this existed before you came. But because you're such a prominent voice and personality, it seems to fit. And the way I characterize this Rick Ruleization of the mining sector is this kind of, in a sense, when we think of China, we think of long-term money. And this is what a lot of people think is holding back the mining sector, that there's too much just in and out. Nobody wants to stay for the long term. And so it's all speculation. So hot money goes into, let's say, uranium stocks right now, and then it'll be sold all out. And so how do you respond to this idea that we have a problem with long-term money in the sector and that it is maybe too speculative? How do you think about this?
I think short-term money is dumb money. I think it's money that doesn't understand how money is made in mining. If you go back to the early part of our discussion, what I described for you is that exploration is a process of answering unanswered questions, and adding value through the answering of unanswered questions takes time. If you, as an investor, haven't correlated the time it will take to answer an unanswered question with the time that you are willing to own the stock, you have deliberately engineered a mismatch in your quest for profit. Let's say, as an example, that you have a project in northern Canada, and the unanswered question involves drilling, which should take 1 field season. But field seasons in Canada are short, so it will more than likely take 2 field seasons. What that means is that if you invest in a company where the answer of the unanswered question is going to take 2 field seasons or 18 months, and in your mind, you aren't prepared to hold the stock for 18 months, you aren't even prepared to hold the stock over a long weekend, you have engineered your own failing. You need to ask yourself, what is the unanswered question? Is it a valid question? Is it a valuable question? How long will it take to get an answer? How much money will it take to get an answer? Both exploration expenditure and general and administrative expense. Does the company have that much money? In other words, can they ever get me an answer? Once you have begun to put yourself through the process of understanding and having a plan for your investment, you will become a better investor. The truth is that for too many investors, or rather too many speculators, as I said earlier, the stratagem is got a hunch, bet a bunch. What is hot, which is a different way of saying what is overpriced. Sadly, in exploration, most speculators have it almost exactly wrong. When I was a young man, Adrian, when I had lots of time left on Earth, I was impatient because I didn't understand the process. I wanted to make money quickly, and I thought that my wants mattered to the task at hand, but the task doesn't care about my wants. I'm now 71 years of age. Realistically, I don't have that much time left on Earth. but I have lots of patience. The reason I have patience isn't because I don't want immediate gratification. It's because I know that what I want doesn't matter. Money is made in the longer term.
Very interesting. So you would say my, little expression there is a mischaracterization of you, because in fact, you are saying you're a long-term investor.
I would love a Rick Ruleism to be an aphorism for common sense.
Okay.
And I think common sense is what is required in speculation. As a speculator, what really matters isn't the 30% trade or the 40% trade. It's the 1,000% win or 2,000% win. Yes, you get some psychological gratification out of a trade that works, but it doesn't change your net worth, really. It's the big winners that matter. And when I looked at my big winners over the last 45 or so years, what I learned is that my average big winner took me 5 or 6 years to achieve. And by the way, Adrian, my average big winner at some point in time during the time I owned it exposed me to a 40 or 50% share price decline. So you have to be persistent, you have to be patient, and you have to be tenacious, or else you will not be rich.
It's a great point, and I actually think of Ivanhoe Mines. I remember you talked about Ivanhoe. It was at I think it was at $3 or $4, and it had dropped to 30 cents at one point, I think in 2016. And I thought, well, I guess Rick Rule got that one wrong. And now, I haven't looked recently, but it was over $11 or $12. I mean, you probably know better than I would what the price is, but, to your point.
Ivanhoe was a no-brainer. I mean, one thing that could happen is it could go to zero. I remember in Canada being on Bloomberg BNN. I guess it wasn't Bloomberg BNN then, it was just BNN. The stock was at 63 cents. It had 96 cents a share cash in it. You were buying the company at a discount to cash. In addition to that, it already had the Platte Reef in South Africa in it. The government of Japan, through JOCMEC, had paid $200 million for 10% of that deposit. So they thought the deposit was worth $2 billion. I mean, the company broke up for $1.50 a share. It could be auctioned off for $1.50 a share, and it was selling for 63 cents a share. This is pretty simple stuff. But because most people didn't try to do the sum of the parts calculation, or because most people had an aversion to the political risk present in South Africa or the political risk present in Congo, they didn't want to look at the facts. People would say to me, yeah, but the Congolese might steal something. And I would say, unlike most of the other companies on the TSXV, this company has something worth stealing. 95% of the companies on issue have something worth stealing, so they don't have to fear being stolen from. This is actually pretty simple stuff. Now, in fact, I thought that the stock could go to $1.50, and it went as high as 15. So yeah, that was one of those that really, really, really worked. There's a lot of lessons in Ivanhoe.
Indeed. And maybe since we're talking about Friedland and Africa, I guess the first thing is, and you've explained a little bit about this with the story about Ivanhoe, but how do you think about jurisdiction? How do you measure risk when you're making an investment? I mean, surely it is a factor.
I believe every single jurisdiction is lousy. Every one. I fear the government most, which touches me the most often. The worst experience with political risk I've ever had was in the People's Republic of California, where we discovered a gold deposit, sadly, 7 miles on the wrong side of the California-Nevada line. And it took us 12 years to get permitting. And then people tell me that California isn't risky. I would ask them to give their head a shake. My experience has been that countries that can't get much worse get better, and countries that can't get much better get worse. So for me, I would rather take political risk than I would technical risk. In other words, I would rather a good deposit in a poor country than a poor deposit in a good country. And that's usually what's on offer. Canada, as an example, is mostly priced for perfection. The most important capital markets in junior mining are in Canada, and Canadians, like everybody else in the world, are ethnocentric. They understand Canadian political risk. or at least they think they understand Canadian political risk, and they're much more willing to deal with that than they are risks that they don't understand. At the risk of offending too many people, I would suggest that people that look like you and I, which is to say Caucasians, don't fear political risk when it's Caucasian and when it steals from us in English, according to the rule of law. We fear political risk in places like Africa and Asia and South America. But the truth is that your money is just as gone, irrespective of how politics deal with you. There's a great deposit right now in the state of Arizona called Resolution, one of the world's great copper deposits, well over 1 billion tons of copper at 1.5%, 3 times the average mined grade worldwide. That deposit has been stuck in permitting thus far for 27 years with no end in sight. Now, on a net present value basis, at an 8% discount, money or free cash flow that has been denied you by permitting for 10 years is effectively gone. And people tell me there isn't political risk in the United States. I have a difficult time arithmetically reconciling myself to that point of view. Africa has treated me extremely well. Have I been exposed to risk? Sure. I was in Congo in the 90s during a civil war, the manifestation of risk. But the upside relative to the downside argues, as far as I'm concerned, for emerging and frontier markets if you invest the time and trouble in that culture, which I do.
Very interesting. Now, since we're on Africa and Friedland here as well, what is your sense? Like, we had an interview with Robert Friedland, maybe 3 or 4 years ago now, where he was talking about how one day he could see the possibility of there being a ESG price for copper and a non-ESG price for copper. And with everything that's happened in nickel recently, we saw the Andrew Forrest of Wyloo Metals in Australia start to make the argument for ESG price of nickel almost as a way of combating this, Indonesian with, Chinese money oversupply of the market. What is your sense of this ESG metal idea? Is it practical? What are your thoughts?
I think it will occur because it's politically correct. I think the big thinkers in the world, I use that big thinker in quotes, the Trudeaus, the Bidens, the Merkels, that noted materials physicist Greta Thunberg, will cause a circumstance to occur where there will be a green metals market, and it will probably trade 4 or 5% of the metal traded worldwide, which is to say it will be a luxury good. The Indians aren't going to care. The Pakistanis aren't going to care. The Chinese aren't going to care. The Indonesians aren't going to care. The Arabs aren't going to care. And they're not going to care that we care a bit. Metal's fungible. So there will be a luxury market, a so-called ESG market, and it won't matter very much to the market as a whole. You'll note on a further sort of fact, materials are fungible. The United States is allegedly in a proxy war with Russia right now. We have these sanctions, and yet American purchases of Russian uranium doubled last year. These are sanctions where nobody's supposed to be hurt, except Russians, I guess, and the Russians aren't hurt. The point of all this, even if the United States Congress imposed sanctions against the Russians, is that Russian uranium would then be sold, had otherwise been sold to the United States. That Russian uranium will be sold to China, and it'll be sold to India. And then Canadian and Australian uranium, which is sold to India and sold to China, would be backed out of that market and sold to the U.S. And it's the same with nickel. Nickel is fungible. The idea that the Western world can superimpose their point of view on the rest of the world is silly now that the rest of the world is solvent.
Very interesting. And I guess a couple of points here. I mean, to your point about only 5% of the market really adopting ESG metal, it doesn't seem like a great time to start having a premium price on, say nickel or metals when all of a sudden everybody is concerned about BYD coming in and undercutting the price of your vehicles. And all of a sudden we're going to add another 5 or 10% to the cost of the vehicle. So to your point, it kind of rings true what you're saying. And I wonder about the practicalities of such a thing. Now, in terms of Russia, this is another question I wanted to ask you, which is, There seems to be an attempt, after the Ukraine war to basically cut Russia out, friendshoring, to cut Russia out of the picture, so to speak. From your understanding of, just general metals, energy, and everything, like how practical is this? It seems to me Russia's a pretty important country when it comes to commodities and resources. To your point, is this just going to be kind of reshuffling things around? Where all of a sudden, instead of Canada supplying a certain country, they supply a different country with metals. How do you see Russia's place and how effective friendshoring can be?
How long have we been sanctioning Iran? Has it worked? Commodities are fungible. We in the West have decided that our values, and by the way, I'm a defender of our values, are sacrosanct. And we believe that we have the right to impose them on other people, whether they share them or not. And many of them do not share them. Unless there's some form of hegemony, and of course the United States wishes it had hegemony, these types of extraterritorial enforcement of your values do not work. Whether they should work or not is something that I'll leave to the philosophers. They just do not work. Allegedly, we're sanctioning the Russians around a whole variety of industrial materials right now. But I would point out to you that part of the weakness in the nickel market and part of the weakness in the PGM market is Russian dishoarding of those metals as a consequence of needing to pay for the Ukraine war. We saw this in 1990, 1991, and 1992. When Russia needs money, they sell what has a bid. And one of the things that they have traditionally had in their cupboard is nickel, platinum, and palladium. Despite these sanctions, the material is getting into the market. With regards to Russian natural gas, if they are denied the European market, or if the Europeans in the future are concerned about having all of their hydrocarbon sources from one country, what likely develops is a European market for North African gas and a Chinese market or a Chinese and Japanese market for Russian natural gas. The truth is that these materials are fungible. And to the extent that the West tries to superimpose its values on the rest of the world, and to the extent that those values aren't accepted by that part of the world, they will be unsuccessful, except in the advent of a third world war, which I hope we don't get to see.
Interesting. So you're basically saying, in effect, to, remove Russia from the supply chain because of the fungibility of commodities is ultimately a hopeless endeavor. You're not going to pull it off. Like, it can't be done. It's absolutely silly. We tried that to ourselves in the United States about 70 years ago. It was called prohibition. We decided that it would be better for people if they didn't drink. We, of course, forgot to ask the people who like to drink. The consequence of that is that when there wasn't legal American liquor available, there was illegal American liquor available, and there was plenty of Canadian liquor available and plenty of legal Mexican liquor available. The truth is that these sanctions are very much like prohibitions. Many right-minded people listening to this interview won't like to face the facts that other people don't like their values, however rightly they may hold them, imposed on them. And the consequence of that is that they will act in their own perceived interest. Now, if we were to abstract this conversation somewhat, in effect, are you saying, you're a self-declared libertarian, are you ultimately saying, like, one of the takeaways here is that markets will triumph over any kind of policy?
In the long term, yes.
To your point about prohibition,
Adrian,
we can make all the rules we want, right?
Adrian, two plus two always equals 4. You can legislate 5 for a while, but you end up a point short. And I'm not trying to say that markets can't be made less efficient, which is to say they can't be perverted by government. That happens all the time. I'm not saying that allegedly market forces, which is to say companies, can't pervert governments so that the companies themselves pervert the market. What I am trying to say is that you can't over time legislate human nature.
Interesting. That's almost what I was going for here. What is the kind of abstraction here underlying? What is the principle underlying our conversation here? Thank you. Excellent. We're getting somewhere, Rick. Now, in terms of, there's going to be a lot of people that are going to say to me, if I don't ask you this, you had Rick Rule on and you didn't ask him what he's most excited about in the market. What is exciting you? We see copper, it looks like it's broken out a little bit. Silver looks like it's still in catch-up mode to gold. What are you excited about when you look at the market?
With the caveat that I am excited about things that are more likely than not to occur over a long term. I don't get excited for quarters because I don't make money in quarters. But what am I excited about? I'm excited about the prospects for gold because gold typically does well during a period of time when people have lost their confidence in fiat-denominated savings products. And I think that the next 5 years will prove difficult for fiat-oriented investors around the world. I'm excited about gold, too, because it's so hated in the broad market. The market capitalization of precious metals and precious metals-related investments in the U.S. market, which is to say the market share of precious metals, is less than 0.5%. The 4-decade mean market share is 2%. If interest in gold, as a consequence of the deterioration of the purchasing power of U.S. dollars, is merely to revert to the 4-decade mean, demand for precious metals-related investments in the U.S. market goes up fourfold. And that's what I think is going to occur. I'm a little more attracted to hydrocarbons because people hate them. The big thinkers in the world, again, will tell you when they fly 1,000 private jets to Davos to ask you to drive less, that peak oil demand will occur in 2030 or 2032. What will power their private planes? Peak oil demand for hydrocarbons will occur something like 2065. And in the meantime, the hydrocarbon business, particularly conventional oil and gas businesses, are generating a lot of money at these price levels. On a global basis, including state-controlled companies, these companies aren't investing enough money in sustaining capital to maintain their current production, which means, ironically, that the prices stay firm. And the good companies are making the sustaining capital investments so that they'll have the production 3 or 4 years out that they enjoy today, while also increasing returns to shareholders. So I'm I continue to be really excited around the conventional oil and gas business. If you're willing to take political risk, then I think Canadians in particular look no further than Canada. The political risk is in Ottawa, but the Western Canadian Sedimentary Basin has spectacular geology, and Canada has spectacular human resources and energy. So I'm really excited about that. But I'm also, Adrian, excited about exploration. I'm excited about the fact that we had an exploration expenditure boomlet in the period 2000 to 2003 to 2012. And in my experience, it takes about 10 years in regional exploration before you begin to get an outcome. And I think we're actually headed into a bit of an exploration boomlet. I think that boomlet will be driven by the realization among the major mining companies that they have underinvested in exploration for about 30 years, and they need to pick up the pace. That will deliver all kinds of positive outcomes, I think, for the juniors. So I'm excited about all of these.
Sounds like an extraordinarily contrarian call. I guess maybe not as contrarian as it might have been before gold breaking out to a new high, but nevertheless, still, it sounds like you're talking about the gold stocks there to a certain degree, and not just there, but even earlier when you're talking about gold mining related companies. So is it ultimately is kind of gold and oil? Sounds like a 1970s trade to a certain degree. Those are your kind of main areas that you're excited about.
Gold is a commodity, and select gold stocks. I think if you invest in the gold stock sector, which is to say you buy the whole sector, you buy the lame, the halt, and the blind, you will lose money. If you pay attention to the serial outperformers, I think you're going to make a lot of money in the next 5 years. And I would say the same thing in the oil and energy space. I think that it is a better sector. The oil business is a better business than the gold mining business. But still, I believe that there are companies that have durable competitive advantages. And I think that investors would do well to focus their time, first of all, investing in their own education, and then investing in the companies that they see as a consequence of their education having durable competitive advantages.
And just to follow up on this discussion then, like, do you have a view on this idea of a commodities super cycle? Again, talking about gold and oil doing well, again, sounds like a 1970s type trade here. Do you have a view on that and maybe inflation?
My gut feeling is we need a recession first, but I'm no economist. I think without a doubt, the whole suite of industrial materials will be in undersupply beginning in about 5 years. We have 1 billion people on Earth with no access to primary electricity. We have another 2 billion people on Earth that have access to either intermittent or unaffordable electricity. This says a wonderful thing for things like copper, a wonderful thing for oil and gas, a wonderful thing for uranium. And yes, despite the fact that the big thinkers don't like it, a wonderful outlook for coal. We have taken, as a species, 1.5 billion people out of the ranks of the dire poor and made them merely poor in the last 40 years. And I think we finish most of the job over the next 25 years. When poor people get more money, the things that they spend their money on are made of stuff, unlike you and I, where we buy services if we get more money. This raising up of the living standards of the poorest of the poor, to paraphrase Deng Xiaoping, to be rich is glorious, is what kicks off this raw materials bull market. But the caveat is, if we have a recession first, you can have declines in supply if you have a short-term decline in demand and you don't have an increase in price. My gut feeling is, I'm no economist, we've been too long without a recession, and we probably need one more cleansing before metaphorically we're introduced to the promised land.
So there is still time because, again, we have a lot of, say, students that are listening to this program, a lot of young people, a lot of people who maybe are listening to you trying to figure out really how to get ahead. And so following up on what you're saying, do you have advice for them then? How would you counsel? And I know not investment advice, but just, big picture. What would you say if you can?
Invest in your knowledge. Read a book called Economics in One Lesson that tells you about how the world is, not the way the big thinkers wish it was. Invest in a book called The Intelligent Investor by a guy named Ben Graham. He had one pretty good student. That guy's name was Warren Buffett. Read The Northern Miner. Go to the rural classroom. There's 200 hours of instructional programming there on how to become a better mining and oil and gas investor. Invest in yourself, then invest in the sector. That's the most important thing. Knowledge can't be taxed, can't be stolen, it can be lost if you forget it. Knowledge is the best investment that you could make. So for a young person, invest in your knowledge first.
Okay, excellent. And just to wrap up on self-declared speculator, what do you think of crypto? We're seeing Bitcoin here break a new record, kind of without the hype, so to speak. There is hype, but it's nothing like we saw, in the legendary year of 2021. As a speculator, doesn't sound like it's, your bailiwick, so to speak, but how are you thinking about that market?
Adrian, I have no fear of missing out. I only invest in things that I think I understand. I don't invest in crypto because I don't understand, other than the network effect and anonymity, its value. I understand conventional financial services. I understand banks, wealth managers, asset managers, insurance companies, and I understand natural resource investors. So I confine my investing to sectors that I think I understand well enough that I have a reasonable probability of succeeding, and by the way, outcompeting other investors and speculators. I don't understand enough about crypto. I don't understand the basics of its valuation. I don't know how it generates free cash. I don't understand enough of it to play with it. I'm delighted that people have made money at it. I think that's a wonderful thing. I'm delighted about the fact that there are private currencies that will compete with government counterfeiting. I think all that's wonderful, but I don't know enough about it to play the game myself.
Fascinating. And final question, any final thoughts for the audience and for whoever might be listening?
My final thought is a commercial. If you care about what I have to say about natural resources and you want to personalize it, go to my website, ruleinvestmentmedia.com. List your natural resource stocks, and I personally, for no obligation, will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have value. Once again, ruleinvestmentmedia.com. List your natural resource stocks. I will personally rank them. If you want to know how I did it, go to the Rule Classroom. 200 hours of instructional programming on valuation for natural resource companies. ruleinvestmentmedia.com, Rule Classroom, and keep reading The Northern Miner. Continuously published for a very long time, responsible for a substantial measure of my own success.
Well, we couldn't ask for a better guest than Rick Rule, investor and speculator and former CEO of Sprott U.S. Holdings. Thank you for joining us and sharing your insights on the Northern Miner podcast.
Always a pleasure, Adrian. Thank you.
Thank you once again to Dundee Sustainable Technologies for sponsoring this week's episode of the Northern Miner podcast. Thank you also to Rick Rule for the wonderful interview and conversation. And it looks like Rick is up for an interview on James Dines, which I think could be an epic summer special. For those that don't know who James Dines is, he is one of the original newsletter writers in this industry. He's an absolute legend as far as precious metals investing and the whole newsletter writing culture. So that should be amazing. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.